Hello, friends. Today I want to talk to you about losses. I know losses are bad for businesses, but they're good for tax return. And this is the tax time. People are looking for ways to reduce their taxable income. They want to pay the minimum tax possible. That, and one of the ways to do that is to make sure that you account for every single loss that you might have throughout the year and you properly account for that on your return. Many times people miss out on those losses. So that's the purpose today. I'm going to walk you through how losses are calculated and how much of that loss can be actually claimed on your tax return. So that will be the purpose of today's video. If you don't know who I am, my name is Deepak. I'm a tax code advisor. So you can reach out to me via taxcodeadvisors.com. Just set up a free discovery call, get to know me, and see if we would like to do some business together. All right. So let's get on to our topic, which is, how do we claim losses on our tax return? So first of all, why would you create losses to begin with? I mean, why would I create loss just because I want to write it off on my tax return? Well, people typically do that because they have high income elsewhere. Maybe you have high W-2 income, maybe you have a high business income, and you're trying to figure out, well, how do I reduce it? You just don't have enough expenses to claim to reduce your taxable income. So maybe you do some other transaction that can generate all bunch of paper losses. Like I said, that could be a syndication, that could be some real estate transaction. Maybe you invested in a business that is not really doing well, or that might do well in future. Maybe in some R&D projects. So there's a lot of ways that can possibly happen. That's not the purpose of today's video. That's a topic for another day. What are some of the ways to generate losses? But anyhow, today we're going to talk about if you already have a loss, how do we claim it on tax return? What kind of limitations we need to check for. So limitation number one, we first need to check the outside basis. So for example, if you're a new business owner, you set up a new partnership. Maybe four of you guys got together, you started a partnership. Maybe that partnership buys a real estate. Maybe that partnership buys a business. Maybe you start something else from scratch or whatnot. So when you get together, you probably contribute some capital to that partnership. That is your basis. So that's where we start with. So when you come to us for a partnership return, the first thing we're going to ask you is, well, how much did everybody contribute it? That's number one. Now, the contribution don't necessarily have to equal to their share in the company. So you can have unequal contribution. That's completely okay. So that's why basis doesn't necessarily mean that they have a equal partnership. Like for example, let's assume the total contribution to a partnership was $100,000, and there were four partners. Each partner contributed $25,000 each, altogether $100,000, and doesn't mean that all of them are 25% partner in the company. So when we ask you a question about contribution, all you're telling me is the basis for each partner is 25,000. Then we're going to ask, okay, what percentage of the company is owned by them? They're two separate questions, so don't mix them together. So that's number one. Number two, um, as the company earns money, so there's some income that gets allocated to a partner. When that happens, their basis increases in the company. So let's say their basis started out with $25,000. Now the company earns another $25,000. The basis became $50,000. And when they take out distribution, or if there are losses, those things impact the basis as well. So we are always doing those calculations. If you're doing your own bookkeeping, you're probably doing it yourself. If you're not doing it, you'll probably engage with us or a bookkeeper who will do that for you. So this is number one. That means you cannot claim losses more than what you contributed in the company. So if you only contributed $25,000, that's your limit. If the company didn't earn anything and you lost entire $25,000, that's your loss. That's the maximum loss you can possibly claim on your tax return, not more than that. Now, is it possible that you might have taken a liability? Okay, can that become part of your basis? Absolutely. So, for example, maybe you bought a property, and in that property, you took a loan. You went to a mortgage company, they gave you $1 million loan. So now your basis is whatever you contributed plus that liability. So the total basis actually increases. Now, we have to be careful with that because there are some liability that are recourse and some are non-recourse. So if the liability is non-recourse, then your basis in the company would not increase. So you have to be careful with that. So that is step number one. We need to check what kind of basis you have in the company. Now, let's just say you don't have a basis. For example, sometimes when I ask this question to people, they says, "Well, you know, I started with the company with $1, and there's no income in it, and nothing else. I want to claim $50,000 in losses." Well, if you only contributed $1, there's no other income. That means your basis is only $1. So that is the maximum you can claim. Anything over that, and there's a lot of different ways people come up with finding those losses, but anything over your basis that get postponed. So you can claim it next year when you actually generate basis. How are you going to create basis? Well, you can either contribute more capital to that business or you're going to generate income. So that is step number one. That is something we call outside basis or basis limitation. Second thing we look at is at risk limitation. So even if you have basis in the company, you must also have risk. For example, let's say you have a basis let's say you put $25,000, but you're guaranteed to get that $25,000 back somehow. I don't know, maybe it's an operating agreement, maybe other partners are guaranteeing you, maybe you have some sort of deal going on. So if that happens, then you lose that basis. That means the basis has to be at risk. So for example, maybe you invested cash in the company. That's good because if company lose money, you can lose cash. Maybe you invested property. Maybe you took on the debt, like I said earlier. So all of those will actually create a basis and you're going to have a risk. That means this is a possibility that you might lose out on that. So in those cases, you do have a risk. Now, if you have a basis, but you don't have a risk, guess what? You cannot claim it on your tax return. Then we need to determine whether you actively participated in that activity or not. So if you did not actively participate, that means, and when I say actively means you're materially involved in it. That means you're actually making the key decisions, you're running the business, you're operating the business, operational kind of engagement in the business. So if you're doing that, then that's an active participation and you're materially participating in that business. And if not, then those losses now automatically categorize as passive. Now, passive losses can only offset passive income. That means they cannot offset your W-2 income, your business income, your portfolio income. Now, there are some exceptions. For example, you can become a real estate professional. You can also do active participation in a rental real estate. Those two are separate conversations. We can dig deeper into those. But, you know, you can get involved in those and then you can still claim those passive limitations. Or if your income is low enough, I think about $150,000 for merit filing jointly, then you can claim up to $25,000 of losses against your W-2 income. But in many cases, if you're involved in some sort of real estate transaction or some sort of business which is syndicate in nature, or that business is way too far away from where you are, you can have all the documentation, but that might still be considered passive in nature. That means if you're trying to take off those losses against your W-2 income, that can certainly get you in a lot of trouble as well. So if you're doing something like that, we need to talk more and make sure you have proper documentation. So this was check number 3. So let me remind you guys. First, we check outside basis or basis limitation. Then we check to make sure that your capital is at risk and you don't have any non-recourse debt. And number 3, we check whether your activity should be considered active or passive. That means you're materially participating in that business or not. If you get through all of those 3, then we run into the fourth and the final one. This is something we call excess business loss limitation, EBL. So this applies after basis, at risk, and passive loss limitation. That means we already applied all 3 of them. After that, if we say, oh yeah, good, now we come to this one. So For 2025, merit filing jointly can have about $626,000 of excess business loss. Anything beyond that, you cannot claim it on your tax return. So you add up all your allowed business losses from all sources. So you could have it from real estate, you could have it from businesses, so we combine it all together. And if the net business loss extends $626,000, then that access is disallowed for the current year. And the access is carried forward as a net operating loss, or something what we call NOL. Now, good thing is, President Trump now allows you to carry NOL indefinitely. And that can offset up to 80% of your taxable income in future years. So that's a good thing. So let's just say a single partner has a net business loss of $350,000, and for single partner, the EBL limitation will be roughly $313,000. That means about $37,000 will become NOL. That means they cannot claim it. They can claim that $313,000 against W-2 income, but rest of it will get carried forward. Similarly, for merit filing jointly, it will be $626,000. Anything over that, that becomes NOL, net operating loss, and that will get carried forward. But like I said, the good news is you can carry it in, forward in future years, not a problem, and you can claim up to 80% of that on your next tax returns. So once again, we start out with basic. We look at the outside basis first. Then we look at risk limitation. Then we look at the passive active loss rules. And if you meet criteria for all three, then we move on to the access business loss limitations. So these things can get a little bit complicated. So I recommend setting up a consultation appointment each time you want to kind of go over, so we can make sure that you're not walking into a trap. So just go to taxcodeadvisors.com and you can reach out to me from there. Uh,